Good afternoon and welcome to the Market Wrap for week ending 27th of August. APW, Stuart Williamson, here at the helm. Okay, this week I thought I'd talk about just about wealth in the UK residential property market, what the future holds and what it may mean to us. And basically a lot of us have got a lot of money tied up in property in the UK, and it's a big storage of wealth for us. In fact, for many of us, it's the biggest single asset we'll probably ever own. So what's going to happen to it in the future is something that is important, and we need to look out on the horizon and see if we can possibly gauge when it might be going to a crash or a fall, or it might be going to be flat, or it might go up. So basically, I wanted to look at some indicators that are things to look at to see what's going on in the market, that you can look at yourselves. You can go onto the internet and look at it. You can go onto research locations and look at it. But these are things to consider, I would suggest at least. There are signs the housing price boom is coming to an end. And who'd be surprised? It's gone up by 13.2% in the year to June. So these are 5 things to look at and consider in your own mind whether you think they lead to good value in the UK market or there could potentially be a fall. Interest rates. Okay, the ratio of home values to earnings is at its highest level since 2007, which is just before the financial crisis market crash, which led to a 20% drop in house prices. Record low interest rates, though, mean that it's still affordable, with the average person only needing to spend 37.8% of their income to pay a mortgage on an average priced home. There's a lot of averages in there, isn't there? This is low by historical standards. And Andrew Wishart of Capital Economics still says, though, this is the best indicator of overvaluation of the housing market, in his opinion. As long as interest rates stay low, buyer demand will stay high, but the market is very vulnerable to the Bank of England's bank rate changes. Capital Economics' current forecast is that the house prices will rise between 7.5% and between now and the end of 2023, as long as mortgage rates stay low. And they say if the bank rate rose to 0.75% sooner than expected, the growth in house prices will be less than 4%, says Mr. Wishart of Capital Economics. If the rate rose to 1.5%, they say prices could drop by 4%. So it's all about what's going to go on with inflation and interest rates. Now, the threat of inflation is the highest risk at the moment, according to Mr. Wishart. If they increase interest rates quicker than we expect, then it could mean that house prices, in fact, the whole economy will stall. Kate Newfield from the Centre of Economics and Business Research and Consultancy says there's talk of inflation getting out of hand, and a year's time from now that could mean tightening of monetary policy just as the economic recovery is maturing. This is where we see the potential problems, and that's the whole point. As the economy recovers from COVID, if they have to suddenly increase interest rates, and that's a threat. If you've got 5.4% in the US, you've got 2.2% in the EU, who are our major partners. If that does happen, then that will cause a problem. So it's a case of how can all these things be balanced? Will the Bank of England be able to balance it to keep interest rates low and keep inflation down? A big thing is the housing supply versus demand. That's one of the indicators to look at, which is basically the ratio of sold stock to available properties, which essentially, means demand and supply, which at the moment is a historical high, according to Royal Institute of Chartered Surveyors, RICS. Since October, it's exceeded the pre-COVID levels. In June, the ratio hit 58.7%, the highest point since July 2002. In July, it dropped 3.3% to 55.4%. It's still exceptionally high. So there seems to be an imbalance between supply and demand, but that imbalance has probably passed its peak. Simon Rubinson of RICS said the July number would still mean annual house price growth between 7 and 9%, and he believes it will continue as long as interest rates remain low. The problem here is a lack of properties being built. This has been compounded by Brexit. 40% of all the builders in London went home. And probably a lot of them Polish. We're having to make our own doors for the first time in 40 years in the UK. The 95% of all wood used to come from Scandinavia. It's not now. We've got to get a lot of it ourselves. So we need to do a lot of planting. And then secondly, the shortage of social housing is so bad. I mean, Margaret Thatcher, when I was growing up, she was a bit of a hero. Looking back now, she did some terrible things. I mean, selling off all the council housing, that really might have got a lot of people onto the property ladder, but it meant there is so little social housing available now. And what we've got instead of social housing, we've got the likelihood of PRS coming in. Big multinationals like Lloyds. Lloyds is expecting to spend 50 billion, that can't be right, perhaps it's 5 billion, on PRS, the public rental sector, which will be posh houses for people to rent. They'll never go onto the housing ladder. Social housing needs to be brought back and built up as it used to be in the pre-Thatcherite days. Another indicator you've got really is watching out for repossessions. Repossessions, if you see a big jump in those, then normally means you're going to potentially have big house price falls. Now, during the pandemic crisis, which is now apparently officially over, there was a ban on all repossessions. Now it's not the case. There was 2,498 in April and June, more than triple the number in the first 3 months of the year, but it's still half the pre-COVID level, which is like a contra-indicator. Perhaps things aren't as bad as people would have us believe. But if it does become more and more repossessions, foreclosures, that sort of stuff, then it will lead to a housing market being pulled back. Another thing to look at is look at that stage of the housing cycle in different regions. There's massive variations across the UK. When it comes to the likelihood of future growth, you've got to look at what has happened since, say, the last housing crisis, 2007, 2008, 2009. In Northern Ireland, prices are still 29.9% below that point. In the Northeast, they're 1.5%. In Middlesbrough, 6% below. And you compare that, if you compare that to London, where I think it is, 63% above the pre-crash level, and Cambridge 57% above the pre-crash level. So there's this huge mixtures across the economy. So you need to look at local variations and decide whether it's a good value location you're buying in. But then this takes us back to really the drivers of economic growth. What are they around the UK? And this is the whole basis on what we make our decisions on at APW. If you look at, for example, Cambridge, which is just below London, the house price growth, that's the centre of Cambridge. But outside of Cambridge, you get good value, quality houses. But why is Cambridge going up? Because it's become a world-renowned, even competing with its namesake in the US, Cambridge, Massachusetts, for the glory of being the leading life science, medical technology location in the world. So that's why it's going up. Incomes are 10% to 15% higher in Cambridge than they are everywhere else in the UK. For gross added value to the product, they're in the top 10. For income, for salary increases, they're number 1. Because these people have moved there to be part of this boom that was all based around a lot of it's based around life sciences and the AstraZeneca effect. You look at other places like Swansea, Cardiff, they're having the same medtech sort of situation. So it's very positive. But then on the negative side, you look at places like Leicester. And Leicester, bless it, was the first city to go into lockdown in the COVID pandemic. And because it was, no one had expertise how to deal with it. So consequently, according to PwC Good Growth report, it's coming out of it the worst. In addition, 52%, I think it is, of the population of Asian extract, which makes them more susceptible to potentially, this is what I've been told through reading the PwC report, to being affected by COVID. So it's come out very badly, which is very unusual in the Midlands, because most of the Midlands has come out very well, because that's where we've got our e-commerce distribution centres, and actually employment is up by 10%, and rentals are up by well over the national average. So you need to look around the UK and not just say, interest rates are going to be high, therefore don't do it. Well, in that case, don't borrow too much money. Don't overgear yourself. Okay, I'm worried about inflation. That will help to a certain extent as to what goes on with your mortgage. Housing supply and demand. If you're trying to make money in a purely Machiavellian cavalier perspective, look for those places with the maximum imbalance. If there are repossessions, it's a buying opportunity. So there's lots of different sides to every argument here, and that is what we need to look at in the housing in the UK, and what we need to look at when making buying decisions. But there are real threats to house prices in the UK, just as there are real opportunities. We can help you at APW. Please subscribe to our newsletter if you wish. Watch our market wraps. Watch our educational channels if you like. Thank you very much for listening. Do take care. Bye-bye.